Hey there, investors! Welcome to another exciting day on Wall Street. Let's talk about something that makes the market go wild: Fed rates. Yes, those little numbers that can cause big waves. You know, those numbers the Federal Reserve, America's central bank, keeps fiddling with. They might seem like just digits, but they hold immense power. They might sound boring, but trust me, they're the puppet masters of the financial world. Every move they make sends ripples through the economy. When the Fed speaks, Wall Street listens, and you should too. Their decisions can affect your wallet in more ways than you might think. These rates influence everything from your savings account to the stock market. They can determine how much interest you earn or pay. Think of it like this: the Fed is like the conductor of an orchestra. When it raises its baton, interest rates, the music or economy changes. When it raises its baton, the tempo of the economy shifts. Sometimes it speeds up, and sometimes it slows down. Sometimes it's a beautiful symphony, and sometimes it sounds like a cat is playing the tuba. The market reacts in unpredictable ways. Okay, maybe not that bad, but you get the point. The Fed's decisions can lead to moments of joy or confusion. Understanding how Fed rates work is like having a superpower on Wall Street. It gives you an edge in making informed decisions. You'll be able to anticipate market moves, make smarter investment decisions, and maybe even impress your friends at parties. Okay, maybe not. But you'll definitely have some interesting insights to share. But seriously, this stuff is important. Knowing how the Fed operates can help you navigate the financial landscape more effectively. So buckle up, Buttercup, because we're about to dive deep into the exciting world of Fed rates. Get ready to understand the mechanics behind those crucial decisions. By the end of this, you'll be speaking fluent Fed and making moves like a Wall Street pro. You'll have the knowledge to back your investment strategies. Okay, maybe not a pro, but you'll definitely be a step ahead of the game. With this understanding, you'll be better prepared to tackle the ever-changing market. Let's break down what these Fed rates actually are. In simple terms, they're like the interest rates banks charge each other for overnight loans. Sounds boring, right? Wrong. This seemingly small rate sets off a chain reaction throughout the entire economy. Think of it like dominoes. When the Fed raises its rate, banks follow suit, increasing the cost of borrowing for businesses and consumers. On the flip side, when the Fed lowers rates, borrowing becomes cheaper, encouraging spending and investment. The Fed uses these rates to steer the economy towards its goals, mainly keeping inflation in check and promoting job growth. Think of them as the gas and brake pedals of the economy. So why does the Fed keep messing with these rates? It's a question that often puzzles many people. Well, they're trying to find a sweet spot for the economy, like Goldilocks searching for the perfect porridge. Not too hot, not too cold, but just right. The Fed's goal is to keep the economy humming along at a sustainable pace, with stable prices and low unemployment. They want to ensure that businesses can thrive and people can find jobs. When the economy gets too hot and inflation starts to rise, the Fed steps in and raises rates. This is to prevent the cost of goods and services from spiraling out of control. This slows down borrowing and spending, cooling things off. Higher interest rates make loans more expensive, which can reduce consumer spending and business investments. Think of it as putting the brakes on a speeding car. Just as brakes prevent a car from going too fast, higher rates prevent the economy from overheating. On the other hand, when the economy is sluggish, the Fed can lower rates to encourage borrowing, spending, and investment. Lower rates make it cheaper to take out loans, which can stimulate economic activity. This can help boost economic growth and create jobs. More borrowing and spending can lead to more business opportunities and employment. It's like stepping on the gas pedal to get the car moving again. Lower rates can accelerate economic growth, just as pressing the gas pedal speeds up a car. It's a delicate balancing act, and the Fed doesn't always get it right. They have to carefully consider various economic indicators and potential risks. But their decisions have huge implications for all of us. Whether it's the interest rate on your mortgage or the cost of groceries, the Fed's actions affect our daily lives in many ways. Section 4. Rate hikes and the economy, a cause and effect relationship. Now let's talk about how these rate changes affect the real world. When the Fed raises rates, borrowing money becomes more expensive. This means businesses have to pay more for loans, which can cut into their profits. Consumers also feel the pinch. Mortgages, car loans, and credit card interest rates all go up. making it more expensive to buy a house, a car, or even just put groceries on credit. This slowdown in spending can ripple through the economy, impacting everything from housing prices to job growth. Section 5. The stock market roller coaster, riding the waves of Fed decisions. The stock market is a dynamic and often unpredictable entity, influenced by a myriad of factors, one of the most significant being the decisions made by the Federal Reserve. Now for the part you've all been waiting for, how Fed rates impact the stock market. The Federal Reserve's decisions on interest rates can send ripples through the financial world, affecting everything from individual stocks to entire market sectors. Remember those company profits we talked about? They are closely tied to the cost of borrowing money. When interest rates are low, companies can borrow more cheaply, which can lead to higher profits. Well, when interest rates rise and profits take a hit, stock prices often follow suit. Higher borrowing costs can squeeze profit margins, making it harder for companies to grow and expand. Investors get spooked by the prospect of lower profits and start selling their stocks, pushing prices down. This can lead to a downward spiral as more and more investors rush to sell, fearing further losses. It's like a herd of panicked gazelles running for cover at the first sign of danger. The market can become a frenzy of activity, with everyone trying to get out before the situation worsens. On the other hand, when the Fed lowers rates, it can be a boon for the stock market. Lower interest rates reduce the cost of borrowing, which can encourage investment and spending. Lower rates mean cheaper borrowing for companies, which can boost profits and make investors giddy with excitement. This can lead to a surge in stock prices as investors anticipate better financial performance from companies. In summary, the Federal Reserve's decisions on interest rates play a crucial role in shaping the stock market's behavior. Understanding these dynamics can help investors navigate the often turbulent waters of the financial markets.